All right, to round it out, I want to talk now about the usefulness and the purpose of the balance sheet. So everything to this point has been about how we classify things, what buckets they go in, if you will. Is it a current asset? Is it PP&E? Is it a long-term investment? Is it a liability? What are the different types of liabilities, right? Equity. But what is the point of all that? So the point isn't just that assets equals liabilities plus equity, because quite honestly, we could keep no accounting records, and that would just have to be true. It's just the natural state of a business that when we are considering the assets and the company as its own economic entity, no resources or assets get into the company unless they were borrowed or they were invested by an owner. So that's not the point of the balance sheet to show that assets equals liabilities plus equity. That's just a natural result. What the balance sheet is about is providing information about risk. So it's really about assessing risks. And the way that it assesses risks is by giving us that separation, that categorization of assets, liabilities, and equity, because the relative mix of these items is what determines risk. So we're going to look at some ratios. They should be familiar. You've seen them in Principles of Accounting 2. Um, but just to note that, it's really hard to know whether a ratio is bad or good on a standalone basis, because really each industry, each segment of the economy has different standards of liquidity, solvency, capital structure. Some will be much more show liquidity measures that are much higher than other industries. Some capital structures, for example, banks are heavily leveraged, which means they have lots of debt, very little ownership or equity. So we have to be careful by just saying, oh, it's over one, it's good, or oh, it's five, it must be good. So just a word of caution there. When we're talking about liquidity, okay, this is very different than liquidation. So liquidation means to sell, right? I mean, it's tied to it because liquidity is the ability to convert assets into cash over a short period of time. So if you think about the assets a company will convert into cash over a short period of time, you can think of accounts receivable, right? Collecting from the people who bought a good or service but haven't paid yet. Now we're trying to collect from them. Inventory, selling inventory is converting assets into cash. Right? So those are the assets we really tend to focus on. It's the current assets and the current liabilities. Does the company have enough current assets to cover its current liabilities? So if we have a measure over one, then that indicates that if you think about the definition of current asset, things we expect to convert into cash or to use up within a year, and current liabilities, those things we anticipate on having to pay and settle within a year, then the ratio here tells me for each dollar of, I have $1 of assets per $1 of liabilities. That would be a ratio of one. If I had a ratio of two, that means I have $2 of current assets for every $1 of current liabilities. So that's what's being captured by the current ratio. The higher the ratio, the better it is in terms of understanding that this company will be able to pay its short-term debts. Now, when we just consider current assets as a whole, we might be missing a little bit, right? We might have some things that are not quite as convertible into cash. For example, prepaid assets. When we have prepaid rent, prepaid insurance, those items are not being converted into cash. They represent cash that we paid. And now we have a contract that provides us with rent or a contract that provides us with insurance over a period of time, but that's not something we're going to be able to sell. So there's a modified or quick ratio, and it removes the less liquid current assets, prepaid assets, and inventory. So what the quick ratio ultimately becomes is cash and equivalents, cash and cash equivalents, which really are just, for now, you can just consider it cash. We'll talk more about their designation in week 5, plus marketable securities. Sorry, almost forgot those. So all those investments that we intend on selling within a year, plus accounts receivable. So we're only including, remember, if these are the 3 most liquid assets. If we were to list out all of the current assets in terms of their liquidity, which is something you need to get practiced in doing so that you know exactly how this falls out. Um, these are the top 3: inventory and other current, where prepaids would fall, are number 4 and 5. So basically, we boot 4 and 5 from the numerator of this. Now, the denominator stays exactly the same. It's just current liabilities. So now we're just getting a more conservative view of exactly how able a company is to respond to its obligations that are coming due within a year. So that's liquidity. And it's measured by both the current ratio, the quick ratio, and working capital, which is just a variation of, instead of taking the ratio of these two, we're taking the difference. Solvency. Solvency is about the long term as they mature in the future. So we're looking at, really, how is this company going to survive over a series of years, not just through the next year, right? Liquidity is all about the short term. Now, solvency and capital structure give us an idea of the long term ability of the company to pay debts as they come due. We do all assets divided by all liabilities. Sometimes we will just look at financing liabilities as the denominator, those ones that bear interest, like bonds and notes payable. Those are my financing liabilities versus operating liabilities. So that kicks out certain, like, wages payable to our employees, accounts payable to vendors that are supplying us with inventory. But that is the idea of the solvency ratio as a whole, to determine what is the long-term survivability of this business. Capital structure. Capital structure is about the trade-off between how a company finances itself. Remember, we're talking about assets, everything the company owns that's an economic benefit comes from one of 2 sources: liabilities or equity. These are my capital. This is basically my capital structure. Am I a company that relies more on debt? Am I a company that relies more on attracting investment? And really, this can tell us whether the company is able to take on more debt, right? As I said, there's some weird industries in the economy, like banks. Banks are about 80 to 85% funded by liabilities, and only 20 to 15% equity. Most other companies have a slight lean toward liabilities, but not like, they all fall somewhere between 45 to 55%. So most companies, most industries tend to split it rather evenly between L and E. But the higher this ratio is, the more problems we could foresee in terms of the business staying afloat. And mostly because these financing liabilities bear interest payments. And if we're unable to pay our interest, creditors will work with us for a time. They'll try to negotiate terms to make the debt payable, because ultimately they want their money back. And they don't want to force the company into bankruptcy, but they will if there is no other path. So if you are inundated with liabilities, that can be a red flag in terms of an ability in the future to sustain the company. And then finally, all of these guys promote financial flexibility. And financial flexibility is just our opportunity to pounce on new opportunities as they arise for the company. Um, the ability to open a new segment of operations, the ability to expand into different geographic locations, the ability to expand internationally, right? These things cannot occur if we have low liquidity or lots of liabilities. We may not be able to expand and draw upon funding in order to get that done. So these are all the measurements of risk provided to us by the categorizations on the balance sheet. So what are some of the limitations of the balance sheet? The limitations, I mean, they're not like detrimental. They just, they're things that we understand that financial statement users, whether you're a banker, an investor, an accountant, you know, we understand the nature of the balance sheet and we understand what it can do and what it cannot do. One thing about the balance sheet is that we do not commonly have market values reflected for our assets. The book value, right? Just basically the book value is whatever the value of the item is on the balance sheet. That does not usually reflect market values. Sometimes we will use market values when we're holding assets for sale, whether that be an investment that we're holding for sale or any other asset that we actually hold for sale. Most short-term investments are expressed at current market value and some long-term investments. So the short-term investments expressed at current market value, those are, for example, trading securities. And some of the long-term investments available for sale securities. So the trading securities are equity investments, sometimes debt investments that we intend on selling in the short term. Trading securities are always current assets. The available for sale securities, those are strictly debt investments. When our company buys the bonds of another company, the debt of another company, and receives interest payments, receives that money as the person who borrowed our money through our investment, pays it, those can be short or long term based on when are they going to mature. Estimates and judgments are necessary. The collectability of receivables, the useful life of long-term assets. There can be very complicated valuation models for certain financial instruments, especially when we're in the financial services industry, insurance industries. Those have some very rigorous modeling that is very much dependent on estimates and therefore not a hard and fast fact. So we have to be careful and always keep that in mind. There are many items of financial value to the business that are omitted. And this is a sort of callback to the monetary unit assumption that we cannot put on the balance sheet an item unless we can hang a price tag on it, unless we can find some way to judge its value. And, the value of a company's human resources and research and development, those don't get reported. The managerial team that is cohesive and synergistic, a CEO that is bright, innovative, those things, we just do not know how to value them. And there's no way we could even start with an estimate to put a value on it. So we just leave those off. This next section is pretty straightforward. I do want you to reflect upon it, that really when we're talking about an annual report, which every company has to submit to the SEC in order to trade on our markets, right? These are publicly available. They're given to the SEC so the SEC can judge compliance even after the auditor has audited it, right? So there's a lot of checks on these things. So what is in the annual report? Financial statements, of course, right? Those are the bedrock foundation of it, very much so. They are a high-level summary, an executive summary, 4 to 6 pages of the anywhere between 60 to 100 pages of an annual report. The footnotes are the huge piece of it, okay? Lots of footnotes. Every major category of assets, liabilities, and equity will have a footnote. where the company will go beyond just an account total expressed on the balance sheet. There, those are somewhat within the company's discretion. There are some requirements in footnotes, but they are not, there's not a lot of requirements and rules surrounding the footnotes. Um, However, there are certain things that must be detailed and disclosed within the annual report, significant accounting policies. So how the company decides to value its inventory, LIFO, FIFO weighted average cost, depreciation methods, revenue recognition practices, how it decides to write off certain debt. These things all need to be disclosed within the significant accounting policies. It's usually the very first footnote that describes the choices that the company is making with the way it reports. And also if there have been new accounting policies that have been put forth by the FASB, then the company will then discuss, hey, this had a material effect on our financial statements, or this did not have a material effect on our financial statements, depending on whether it affected the company's operations and how they report. Subsequent events. So there is a lag between the fiscal year end and the publication of the annual report. It's typically about 3 months. And things could, of course, happen in those 3 months. So there might be ongoing lawsuits or contingent events, product recalls that have been settled to some degree of certainty that then need to be incorporated. They would not necessarily affect the reporting in the balance sheet income statement, but they need to be described in this footnote. The disposal of major assets or divisions in the company, we're going to talk more about that when we get into the income statement, and the issuance of debt or equity. If the company is issuing debt or equity in that 3-month window, then it's something that we want to be aware of as the report is published. Related party transactions, anything that is done with the managers and the owners of the company. It could be with a subsidiary of a consolidated company. So those things are probably going to depart from normal business transactions, and we need to put a spotlight on them. The MD&A is a very interesting part of the annual report. This is where the executives of the company can kind of PR and put things in the best light possible. They will even go so far as to draw up data tables and show growth projections and income projections and modified income. And the one thing that we really need to be careful of is that these are all what we call pro forma. They're information that is not in alignment with US GAAP. So it can be biased, right? However, we got to balance that against the idea that here's the executive's chance to tell the story of their company, what's going on, what they have planned, right? Are they going to make changes in dividend payments? Are they going to do some new sort of financing outreach through share repurchases, new equity issues, or issuing debt? Right? New developments, new product lines, things that they're working on that they're putting out. The summary of the manager's responsibilities has become something that has been put in place and beefed up since Sarbanes-Oxley, when the Enron CEO and CFO declared plausible deniability about the fraud that was going on in that company. And so now that just sort of locks them in terms of saying, well, I am attesting this. This is my responsibility over this information, so that they can't give a sort of, oh, that wasn't my job story in the courtroom. Auditors report. This is obviously another very important thing. Auditors only audit annual reports. They do not audit quarterly reports. And so when they audit, it is a very stylized, meaning it's almost boilerplate, meaning you could just cut and paste the words from most auditors reports within annual reports, and they will be the same. They come in different flavors. And that's the flavor is which opinion did the audit firm select? They could say it's unqualified, right? There's no departure from GAAP. It could be qualified, which means there's something going on that's not necessarily it's a small infraction, not enough to invalidate the financial statements. So it's not material, but it's still present. Um, Adverse opinion. So this is when we have a severe departure from GAAP, and the disclosure of items is totally insufficient, or perhaps just a disclaimer. So this one's a little bit more neutral. It just says, hey, we didn't have enough evidence to really give you an opinion. You should know the different types of opinions: unqualified, qualified, adverse, right? Good, medium, bad, and neutral. So that is really the annual report in a nutshell. Be cognizant of the different sections as I've broken them out here, and what each one offers and how it fits into the overall story that the business is giving us with the annual report. And definitely understand the purpose and the use of the balance sheet, because what's the point of making one or knowing how to make one unless you know how it's getting used?